Kevin Warsh, a former bank executive and Fed governor during George W. Bush's presidency, is set to take over from Jay Powell when he leaves the seat in May, pending confirmation in the Senate. On the heels of Trump's announcement, I spoke with Fed Governor Stephen Miran, who might find a like-minded colleague in the new Fed chair.
Chairman-designate Warsh has a long and illustrious career in history as a very insightful thinker on monetary policy. I think he's a fantastic pick from the president. I think he's got enormous credibility. I think he's got enormous gravitas. I think he's got enormous respect from financial markets, from economists, from everyone. I think he's going to do just a knockout job.
I'll talk about your experience. You came to the Fed from the White House, and I'm sure you know people said he was just put there to do what Donald Trump told him to do. Did Donald Trump tell you to do anything in particular, and do you think he told Kevin Warsh that? And even if he didn't, how did you and how would Kevin fight the perception that he's the president's man inside the Fed?
Look, the president has never, ever asked me to do anything on monetary policy. He has never asked me to do any specific action on monetary policy. He's told me his views on monetary policy, but he tells the whole world his views on monetary policy. You know them as well as I do, right? That's not a secret. He's never asked me to do anything. And I wasn't in the room with any of, Chairman-designate Warsh's conversations with the president or anybody else involved in this selection process. So I don't know what those conversations were like, but if they were anything like the conversations I had with the president about monetary policy, then he wouldn't have asked him to take any specific actions.
Well, how do you get the public to realize that?
You do that by taking policy actions that are consistent with the data. And I think that, I've laid out a case where the inflation measures that are consistent with supply-demand imbalances in the economy, the inflation measures that are relevant for monetary policy, are indicating that there's no material overheating, that there's no material inflation issues in this country right now. So by taking policy steps that are consistent with the economic data, that are justified by the state of the economy, I think you're delivering the right policy.
Earlier this week, David Weston spoke with Jason Furman after the Fed's decision to keep rates steady. Furman is a professor of economics at Harvard and served as chair of the Council of Economic Advisors under President Obama.
So, Jason, we heard from the Fed this week, and I guess I'd say like the kid in the back of the car, are we there yet?
We're looking pretty close, and they just sounded happier than they've sounded in a while.
It's interesting, they didn't even talk about balance of risk. They said we're aware of both the risks, but they both have diminished. What's happened that's given them more confidence, apparently, than before?
Well, the unemployment rate ticked back down, and a lot of people are expecting maybe it'll be stable this year, and the couple-year rise we've seen will come to an end. On inflation, the numbers haven't gotten much better, but there's a real softness in them. There's a little bit of softness in the labor market. There's some quirks that have been elevating the numbers, and so I think it's reasonable to think inflation's going down, not up as well.
The Fed will remain data dependent, that is to say things could change. And so things could change for the rest of the year here. If it changed, for example, on inflation, where do you think it would come from?
On inflation, it would be, first of all, inflation expectations, and different measures are saying different things. Some of them, for example, the conference board this week had scarily high inflation expectations. I think that was probably, people reflecting the political situation and their general fears about the world, not a specific forecast for inflation. That's one place it could come from. Another place is if we do see a lot more tariff pass-through going forward than we've seen to date. I think we're through most of the worst of it, maybe another quarter or two. But, this is an unprecedented situation in terms of the way we've raised tariffs, so we can't be totally confident about how it plays out. And then the very last thing is there's a lot of tailwinds in the economy right now. There's a fiscal expansion, there's a data center expansion, there's a weak dollar. All of that will put upward pressure on the economy. Will it show up in real growth? Will it show up in inflation? No one can be totally confident of the answer to that.
Do you have a theory about why we haven't seen more inflation because of tariffs so far? I mean, if we went back a couple of years, a lot of people would have predicted we would see more than we have. Why haven't we?
Businesses have absorbed a lot more of it than we were expecting. Some of that may be just temporary, and eventually they'll pass it through. You look at the auto companies, and they're selling cars at a loss. They're not going to sell cars at a loss forever, so if the tariffs stay there, they're going to raise their prices. The tariffs have also just keep getting dialed back. So originally, the announcement was for an average tariff rate above 20%. Now we're tracking around 11 or 12%. So it's maybe half as many tariffs as were originally announced.
So unemployment has also stabilized, actually went down a little bit. What is the cause for that? Because on the one hand, we hear businesses don't have the same certainty, they're a little more reluctant to hire. I think there's a consensus they're not hiring as robustly. At the same time, we don't have more unemployment. How much of that's because we just limited the supply because of immigration?
And most of it is because we limited the supply because of immigration. We just don't need that many jobs to keep the unemployment rate constant. We haven't been adding that many jobs lately, but in an economy with an aging workforce, with low fertility rates, absent immigrants, we wouldn't necessarily need any jobs to keep the unemployment rate constant.
The Fed decision and the news conference was not the only news of interest to Bloomberg viewers, listeners, watchers, readers this week. We also had a lot of talk about the U.S. dollar. The dollar has weakened rather significantly, and we had President Trump say, yeah, sure, it'll seek its own level, which is not normally what I expect to hear out of the President of the United States.
Yeah, whenever I hear Treasury Secretary say we believe in a strong dollar, there's a part of me that's sort of bothered by that. First of all, it's not like up is always good and down is always bad. It depends what you want the dollar to be. Moreover, it's not clear why markets should care when a Treasury Secretary says that. So in a way, I found it actually quite refreshing that President Trump, first of all, is open to a weaker dollar, and second of all, actually said the correct thing, which is the market's going to decide. It's not going to be words from him, Scott Bessent, or anyone else that's going to decide where the dollar goes. So I sort of found that statement slightly charming.
At the same time, the president explained why, in part, he liked that, because he said we get to sell more. It really helps our exports, which I think is true. It was lower price, essentially, to the rest of the world. But he didn't capture the other part of it. We could be having higher prices for what we have here. It could it not, exacerbate inflation?
Absolutely. And I think it might be the right thing for the U.S. economically. We have too large a trade deficit. We still do. And a weaker dollar would help redress some of that imbalance in the United States, some of those global imbalances, but it would do it at the expense of American consumers. Higher prices would drive consumption down. Historically, it's actually quite unpopular to have weaker currencies. In fact, in countries around the world, you've seen governments toppled when the currencies weaken precipitously. I don't think it's going to be as dramatic in the United States because we don't trade as much as many other countries do. But on balance, my guess is this might be good economically, but bad for him politically.
We also this week had a fair amount of turmoil, volatility, I guess we'll say, in the Japanese government bond market. What is going on there? Is that simply an adjustment of the economy coming off of a zero inflation base, zero rate base, or might there be something more profound?
Look, for a long time, there were the laws of macroeconomics that applied to every country on earth except Japan, and then there were a separate set of rules for Japan. And this week looked to me like the normal rules of macroeconomics applying in Japan too. So the only thing that was unusual about it was that it was normal, and we've gotten just so used to Japan being anything but normal.
At the same time, Japan has a fairly high ratio of borrowing to its GDP. Certainly, I think the highest in the G10. They don't have as much fiscal headroom to deal with things. And part, I think, of what happened with the JGBs was when Prime Minister Takaichi said, we're going to suspend some of these taxes, and they explained how she's going to pay for it. How much flexibility do they have? Could it be an early example of sort of the pressures on governments, including the United States government, of having such high debt to GDP ratios?
Yeah, you think about when Liz Truss made her announcement and the huge blowback against the pound. This was a bit smaller than that, which makes sense. Japan is a bigger economy and has a larger base of domestic saving relative to the UK, but it's not quite at US level of exorbitant privilege, and even if it were, it's way above US levels of debt and way above US levels of borrowing. Now that you also have inflation there for the first time in a while, there's, I think, good reason for investors to want to be compensated more for lending to Japan than historically they had demanded.
You, of course, are an economist, but geopolitics can hit economics at the same time. We are seeing a back and forth with the United States and its traditional allies about exactly who's on whose side and are we together or not. What effect could that have as apparently maybe some boundaries start getting built?
Yeah, so far, one of the surprises to me last year was that most countries in the world did not retaliate to US tariffs. Canada did, China did, most everyone else prepared plans, put them on the shelf, and they're still sitting there on the shelf. The question is what happens this year. With Greenland, it seemed like there was a more credible threat of retaliation, and that was part of why the president may have backed down on that. Are you going to see more of that? And I think to some degree it'll depend on the direction of travel for our tariffs. If we start peeling them back, making exceptions and reducing them, then maybe other countries will stay quiet. But we try to do another round on top of what we've already done, and I think we'd see a lot of retaliation. But then again, I thought we'd see retaliation last year, and I was wrong then.